Hello, everyone. Welcome to Janover and CBRE's What's Happening in New York Real Estate. Just a little update on the New York and tri-state area real estate markets. With us today, we have Daniel Kaplan from CBRE. I want to thank Daniel for coming, and CBRE and himself provided a lot of the numbers and a little bit of the color today of what's happening in the New York real estate market. The agenda for today, residential market update, then we're going to go into the retail market update and the office market update. We're going to talk about the political environment in New York and the surrounding areas, which is greatly going to affect real estate. And then we'll talk a little bit about some opportunities in tax planning, what stimulus there is out there for real estate, and real estate taxes. That's a big issue in real estate right now. Uh, I just want to introduce Daniel quickly, and you can give a little update about yourself, Daniel.
Thanks, Jason. I'm happy to be here. As Jason mentioned, I'm at CBRE. I'm in the capital markets group with a focus on investment property sales in Manhattan and Brooklyn and Queens, under $60 million. I've been at CBRE my entire career, over 16 years, and happy to be here today. So
And we're happy to have you, and thanks for joining again. So we're going to just jump right into it. The residential real estate. Right now, New York is really a buyer's market for residential real estate. And all buyer's market really means is there's more people selling than there is buyers buying. And we're going to see how that affects the market. Rents for first part have fallen to 2010 levels. What that means is in March, the average rent, the median rent was $3,500, and it actually dropped down to $2,700 in November. That represents a 2.7% decrease compared to the same time last year, which in 9 months is a huge drop. Median rents in November fell about 6% in Brooklyn and Queens. So while interest in Brooklyn and Queens are picking up, it's still a drop in rents. And these cuts are taking place that we're finding in the more affluent areas, the lower income, the stabilized housing, low income housing. Those really aren't being as affected as much. Talking about a little bit of primary residences, sales price for condos and townhouses in Manhattan has decreased year over year by approximately 24%, which is just a huge decrease, and it's almost unheard of in New York. Brooklyn median sales price fallen 18%. So once again, we're seeing the outer boroughs, there is more interest in it than Manhattan itself, but we're still seeing falls. And then there's once again, things that are affecting the residential markets right now, rent, multifamily. There is a moratorium on residential evictions in New York till May 1st. That could get extended, by the way. They kept on extending it, so we're going to see what happens there. And just to point out where we're at right now in the residential market, it took 2 years after the Great Recession to hit this. This happened in 9 months. So that is something to be aware of, that the faster it goes down, the faster it could come back up. Even with the surge in the outer borough, there was still a 50% decrease in sales. And once again, we're going to watch that. But at the same time, Long Island, and as you can see on the screen, Westchester saw the median sales increase 20%. And Long Island had some pretty nice increases as well. Just to talk quickly about the residential sales, the primary residence, you can see that the outer boroughs took a quick hit in the bottom, Bronx, Queens. It went down, but then it went kind of back up a little bit and it stabilized. Manhattan, on the other hand, kind of came down, and it's trickling up, down, and we're going to see that probably throughout the winter as it stays cold. Talking about like investment properties and multifamily sales, despite strong metrics, we're really seeing sales volume down, 50% down before the pandemic in 2019. Yeah. If you could add some color to this, Daniel.
And Jason, I think it's important before we tie into it. Obviously, my focus is on the commercial end, which includes office, retail, multifamily apartment buildings. So separately from the residential, but just in general, before we start breaking down on the micro different aspects of the commercial market, I think it's important to make note, just in general, 2020 was a year where we saw almost a 50% decline in overall investment sales volumes, which is what I focus on, the sales of property. So that was down almost 50%. And from a dollar standpoint, we went from $413 billion of commercial transactions to, down to 214. So a significant amount in terms of a decrease on the transactional side. Residential fared better. That was only down, I think, off just, slightly at 40%. So still down significantly. We have not really seen a full slide in pricing just yet. And I think as that's really due to the fact of the bid-ask spread between where sellers' expectations are and where buyers are. And to segue into the multifamily, what Jason was just saying is the multifamily world pre-COVID already was going through a monumental shift relative to the fundamentals changing due to the rent regulations in 2019. So post-rent regulations, we saw a drastic decline in investment sales and as well as pricing. So factor that plus the pandemic, the multifamily world has significantly shifted relative to where we were in a pre-rent regulation world. I think this is a market that's still very interesting to investors domestically and locally. And there's a lot of interest, on these type of assets, but that interest really has shifted from operators who are coming in, investing, trying to bring these to fair market, to now shifting back to where we saw years ago, where it's long-term fundamental owners. We're just looking at this more as a bond on a cash flowing basis.
No, I agree with you. When I first came out of college, I saw people buying real estate for the cash flow. And then after the Great Recession, after 2007, 8, 9, really did see a change in the market where people were buying for the future value. And that to me, that took place from 2007, 8, 9 all the way till 2019 when the rent regulations changed. I think we are seeing back to fundamentals, as Daniel said. I think people are now looking at more of that fundamentals. Something else to mention that's really like almost like a cliff, and we don't know what's going to happen, is there's more than 100,000 evictions pending right now. With that eviction moratorium in multifamily, people are staying, people aren't paying their rents. We don't know what that number is because it's just not being collected. It's not a vacant unit. They can't kick them out. And 14,000 of those or more actually now have active warrants. So people are going to start being kicked out, and what's going to happen there is still unknown. Hopefully they'll start paying their rent again once the pandemic's over. So that is something that's going to have to, be a fact. I think, Dan, you talked about the difference between the buy and the sell price. I think part of that is that vacancy number where the buyers want probably a higher vacancy. And
I think, Jason, what we're hearing across the board from all landlords, whether they're small one-off mom and pop owners to the largest institutional landlords in the city, is vacancy right now is hovering around 20%. And that could be a institutional owner that has a 12 building portfolio or a small owner that has 5 units.
Yeah, no, I agree, and we're seeing the same thing in our clients, and I think that it's really interesting to see that different areas are happening different things. You talk about a 12 building portfolio. One building can be, really doing well, 2%, 3% vacancy, just normal vacancy, and another vacancy can have more than 20%. And that's where we're getting that average of 20% and from our clients' perspective. I think multifamilies would be really interesting to watch because that has been the most consistent over the years with less drag. And as we're seeing back to fundamentals and we see what those vacancy rates are going to flat out to, and the summer, quarter 3, quarter 4 of 2021, I think it really is going to be interesting on, are we going to stay at the fundamentals, or are people going to be buying distressed debt at a little bit higher price, and hopefully, the vacancies will come down. So I think it's a really interesting thing to watch in the future too.
Yeah, and just to note, I think the data hasn't filtered out yet, but we believe that January is going to be the most velocity on the leasing market relative to New York City. And as we move forward, our expectation in talking to clients is, listen, once we have the vaccine, once the restaurants start reopening, once we have better weather, there are a lot of the younger generations who are living at home or they've gone to warmer weather climates. They're going to start looking to lease space back in New York. They're going to come back. Their jobs are going to be reopened. And we expect from a rental basis, the residential vacancy to really start declining as we get to the spring and summer. And also with the schools around New York City, that's going to have a huge effect on the multifamily world.
Do you think that the lower price is having that effect too, where people maybe would not have re-signed at the $3,500, but now that it's at 27, they're more eager to say, okay, let's lock in a 2-year lease?
Well, I think that, and the fact, I think that where that has an impact potentially is when you have younger people who are living outside the city and they're saying, hey, we were going to be living in Island City, or we can be living in Midtown or Gramercy. So you might, I think there's an opportunity for people to start taking advantage before they see rents start to increase, but I think it's going to have more of an impact relative to maybe the city versus the outer coast.
Yeah, I'm also interested to see the college kids, the people that were juniors and seniors are now leaving college. They didn't really have a full junior or senior year in college. They weren't allowed out. Restaurants were closed. Are they going to want to move to a city and have that experience? I think it's going to happen. So it's really interesting. So we're going to move on to our first polling question. It's going to pop up. And it's a quick question, where do you think residential vacancies will start to turn around? Choice A is the second, third quarter 2021, fourth quarter 2021, or later. We're really just interested to see what the panel thinks, and the people that are on. It'll be up for a few minutes. I think, Dan, going back to it, I think multifamily is going to end up being the most stable over the next few years. I really do.
Well, Jason, and I think we're seeing that right now relative to the transactions that we're seeing that are being done in the marketplace, whether it's transactions coming to market, is we're seeing the majority of transactions are on the industrial and multifamily side, the sub $20 million 5-unit walk-ups that have, fair market and even stabilized tenancies. So you have a consistent cash flow. Payments are up. I think, there was a worry early on relative to payments and, whether tenants will be paying. And I think for the most part, we've seen that. I think payments are hovering around 88 to 90% across the board. And I think just multifamily, I think right now people view that and industrial, which obviously the shift from e-commerce to industrial has been occurring over the last 24 months. So those are the deals we're seeing that are trading right now, and they're obviously trading at discounts to pre-COVID and even post-rent regulations. But I think long term, that's where people really can see growth.
Yeah, I agree. So just to look at what everyone answered, most people think, it's a pretty big spread. Most people think by the fourth quarter of 2021, we're really going to be back. I think it's going to be a little sooner. I agree with Daniel that it's going to be probably over the summer where people start leasing, but it's going to take, I think, a little bit of time for the information to trickle out. And I think that it kind of, once the vacancies start dropping and you show that there's leasing, it's going to really pick up. I think the panel kind of is right. By fourth quarter, I think it's really going to almost get back to where we were in 2019. Maybe not the rents as high, but definitely the vacancies. Moving on to retail, this has been a big question for many years. It's not just 2020, but the big thing that drives retail is consumer confidence. Consumer confidence is down almost 90% from the preceding quarter, and I know that's a big drop quarter to quarter, but it also represents the 6th consecutive quarter of consecutive decline. Really shows that this started, and if you look at the chart to the right, it really started around 2014, 2015, where the prices dropped. Retail rents dropped 9.9% year over year for the fourth quarter of 2020, and that's a 13th consecutive quarter of decline. And once again, you can go back to the chart where it's really started in 2014, 2015.
Yeah. And I think, Jason, to your point, obviously retail is a challenge relative to the amount of vacancies and pricing prior to the pandemic. And this is just exacerbated for the problem. And I think what you're going to see is right now, obviously Midtown and sort of the commercial districts are the most impacted. But we are seeing in residential areas where you have density and foot traffic, and retail is strong. And I think from an investor standpoint, before, again, what I was discussing on the multifamily world, where you have people look at an opportunity to get tenants out, increase your rent roll, get market rents. Investors previously were looking at vacancies or even tenants that had cash flow. How do I get them out to increase the rents? And I think now the biggest question is on a vacancy, how are people underwriting relative to where the market's going to be in 2-3 years? And it's very hard. So I think investors would be very conservative, but I think good foot traffic locations with good credit tenants and term, those are still attractive. I mean, we just did a deal on Bedford Avenue in Williamsburg, next to the Apple Store and Whole Foods. So it's good a location you can get from foot traffic. It was backed by HSBC was a tenant, and Dwayne Reed Walgreens. And that sold. That was one of the largest retail transactions that we took to market post-pandemic, closed in the fall. But I think that's a sentiment to, it's in a demographic where you have a lot of people who live around the retail, strong credit tenants, and cash flow and term. You know, the weighted lease average of that deal was about 10 years. So investors are going to look to that. I think the vacancies, I'm seeing a lot of opportunities from investors who want to buy into New York, but it comes down to where the retail market's going to be. And until we start to see leases, until we start seeing the vaccine in place and people coming back to the office, it's going to be very hard to dictate where those rents are going to be.
Yeah, I think a big part of that is the momentum that's picking up that we're seeing is big national chains. It's not the mom and pops that are starting to lease again. And those big national chains, they have better credit, they have more stable rents, they pay on time. So those leases are going to be a little different. And I think it's a big question. I think a big question is, and I think why it's getting back to 2011 levels of rent is because usually those retail tenants pay a portion of the real estate taxes, they pay a percentage of the CAM, escalations, all these other costs of the building. And when that's vacant, that really hits the investor, the owner, really, really hard. And I do think that they're willing to take a less of a rent if that tenant is going to take 20, 30% of the real estate escalations. And we're going to talk about real estate later. I think that is playing this, the cash flow. I think people are willing to go down in rent just to get somebody in there. Availability is also increasing, Dan. So,
Yeah.
you know, that this is also kind of like a buyer's market.
Yeah. And I think here's the thing. What we've seen in the retail market is obviously we're seeing a lot of rent deferral and tenants that are saying, hey, we're just trying to weather the storm here. Give us 6 months free, 12 months free. We're also seeing all the new deals that are coming to the market are mostly percentage rent, or at least percentage rent for the first 12 months to say, hey, we're in this with you. Listen, it's good for a landlord to have retail, right? It's good for the multifamily, the larger buildings. It's good for the office tenants to have amenities. And then we'll talk about the office market and how that, you know, you want to have a draw to get people to the office buildings. But concessions, free rent, I think, you know, the discounts from where we are, from where we're going is still hard to say, but you're seeing, you know, food, fast casual, you're seeing medical, you're seeing school. So, and then you're going to see a shift into a post-COVID world, and different type of businesses come into play that are going to have to be re-envisioned for a new environment. So, you know, I think, listen, it again comes down to where the demand is and the rent, and landlords and tenants coming to a middle ground. But I think if you have tenants that are working, trying to get through this with the concessions and the free rent, you know, that's our hope moving forward.
Yeah, I mean, look, I threw up the Upper Madison Avenue because it had the biggest jump in availability. And I think that's totally tied into the office, right? So as you said, as the vacancies in residential come down, there's going to be more foot traffic. And I think
Madison Avenue too,
go ahead.
Pre-COVID was also, the spreads between bid and ask were significant there as well.
Yes, but once again, I think they all tie together, right? We just talked about the residential, 20% vacancy. When that goes away, there's gonna be a lot more foot traffic. I think that those locations are gonna be more wanted for the, you know, the restaurants, for the, you know, the small mom and pop shops, and yes, the big retail chains. But once again, I think that we can see the future in the big retail chains. They have a lot of data at their disposal. If they're taking up a lot of this retail space, they're betting on New York coming back, and they're getting a discount at the rent right now. So I think that that's a really good sign. And to talk about what you talked about earlier, a lot of our clients have retail, you know, maybe a mixed use property with residential above or office above, and they have the retail floor. And from March even till now, there's not a week that goes by that someone isn't reaching out to us saying, what do I do? They want to renegotiate the lease. They want to, and yes, percentage rents are coming in. You know, they're renegotiating the rent, signing a new lease at this point. Some people are taking advantage of it and saying, hey, I cut my rent in half and I want a 10-year lease. You know, so we're advising residential and retail and office owners not to necessarily sign new leases, but yes, weather the storm with them, keep good tenants in, and this is a good time to get bad tenants out. So I think we're gonna see a lot more mixing up in the retail as office and residential comes back. I think it's gonna really play a big role. Anything else you have to add, Dan, before we hop onto The Office?
No, I think we covered it all, and I think, listen, as you said, the multifamily and commercial and everything sort of comes together. And as again with everything else in the next few months, I think people coming back to work, schools, it's really hopefully shift on a positive momentum.
I agree. So from an office perspective, we actually saw more people going to the office over the summer. It kind of was like a little bit of an economic recovery. Some restaurants were opening up. And then as soon as early fall hit, the weather got colder till now, we're really seeing any of that recovery being hampered a lot. Leasing activity this year fell 64% below its 5-year quarterly average, which means it's down 78%, which is just a huge number, but kind of expected in a time where not a lot of people are going to the office. Leasing activity and renewals are down 37% this year, and renewals accounted for 35% of the velocity versus 21% in 2019. To me, that shows that the price drop and the uncertainty is really keeping people where they are. The availability rate increased, 15%, which means people are, not renewing and they are more vacancies. But as I think, Dan, as we were discussing yesterday, a lot of that is in the sublease space market. And
Yeah, yeah, I think the sublease space, is factoring for a significant amount of the vacant space right now. And I think a lot of the tenants really are being sort of patient and disciplined to see what's going to happen over the next few months. But I mean, what we're hearing from the larger, institutions, the banking, some of the larger tech firms is they want their people in the space. And when they can start getting people in the space in the summer, I think you're going to see a lot of other firms who are quote unquote punting from an office standpoint to start taking advantage of those deals long term. And listen, we haven't really seen a shift in rents. What our viewpoint is, and I think is, listen, no one's denying that the office market, the world is changing, right? There's always going to be now a dynamic sort of a integrating work and home. But I think from the standpoint of just an overall office viewpoint, I think firms are always going to have offices. They're going to probably decrease some of it, but they're going to need to have it. Their people are going to need to be in the space to be collaborative, home balance. Office landlords are going to make amenities, to tie and to try to draw tenants back into the space. You're going to have some of the, listen, I don't think there's really going to be a drastic shift in the Class A large buildings, but maybe some on the Class B, Class C, where some of those less corporate tenants may be taking less space. You might have those buildings be shifted into residential or some sort of collaborative space. So you're going to see a shift on some of those smaller office buildings. It may be something else, transformative retail, or something that takes advantage of the space in the near term.
yeah, I just want to look at some other indicators that affect office, and you kind of touched on some of them. First of all, unemployment in New York is at 12%, possibly higher. That will go higher this winter, and normally that's around 3%. Stabilized over the last decade. And then even a bigger problem is the office using employment fell to its 19-year low in May. So even the people that are working aren't really going to the office. Once again, we already talked about the sublease space and the renewals, but I agree with you 100%, Dan. I mean, just working with Janover and some other accounting firms, some law firms, our professional services department at Janover, we're seeing that people want to get back to the office. We're seeing that people miss the human connection. Is there going to be a fundamental switch to maybe more days working at home, or maybe Fridays are office free, or something like that in the long term? Yes. We're never going to have to go. I don't think we're ever going to go back to 5-6 days fully time in the office. But I think that some companies that were maybe downsizing and doing more hoteling, even before the pandemic, 17, 18, 19, we were seeing that trend of hoteling going away to people wanting their own space, wanting their own office, wanting their own desk. And with the pandemic, I think that's really going to push away from the hoteling. So I think there's going to be a lot of companies out there that did hoteling and had less space. Now, after the pandemic and people start coming back in, I think they're going to be wary of sharing a desk, of going to a random spot. They want their desk clean. They want it to be their space. And I think that's going to last quite a few years. So once again, I don't know what's going to happen in the office, but I agree with you that I think the most big companies and even the smaller companies, even in the B and C space, they're still going to have the space and they're still going to need it because people aren't going to just jump right back into hoteling. They're not just going to jump right back into, sharing days, getting to the office that day and saying, oh, that was my desk yesterday. Now I'm going to sit over here and someone else is sitting there. So I think that the level of space is actually going to increase. And I think that if you look at Amazon, Facebook, and all the other companies that took big office spaces in 2020, I think they're taking it because they see that as people want to be in the office and people want their own space.
Well, yeah, Jason, I just think you have to look at it too from the standpoint of, we talk to investors every day and, all the international groups, the Koreans, the Germans, they still want to invest in New York and office. I think what you've seen in terms of, sort of a lag on transactions is on office buildings that have, as I mentioned earlier, vacancies or have leases rolling, is where do you underwrite the rents to? And I think that's the biggest factor right now in terms of where we're seeing pricing going to be. But as we start to see leases, we'll start to see more transactions. But our institutional group, closed the biggest post-COVID deal at almost $1 billion, selling a fully leased building to Amazon First Republic Bank on 10th Avenue in December. So that was almost $1 billion investment from office investors banking on New York City office. Again, fully leased with great credit. But that, to me, that's a pretty big sentiment to the long-term fundamentals in New York City office. So.
Yeah, I mean, I also think if you look, I mean, there's a chart here about the submarkets in New York City. I do think that there could be a little bit of a shift from the outer boroughs, that people that used to be in the outer boroughs in the office space might say, hey, I can get Midtown Manhattan at a B, property for similar pricing. So I agree with you. I think pricing is going to lead the way, and it's going to depend on the vacancies, and it also depends on what people come back to. I think that this is a big one where the residential is going to play a big part of it, right? So if people are staying in the outer boroughs, they only want to work a few days a week in the city, that's to be a shift. I don't see that happening though. I think the residential is going to come back, and then people want to go back to the office.
Yeah, listen, I think there was a talk initially about suburban office, becoming sort of the hot new office market. And we've seen a little bit here and there, but we haven't seen the transaction volumes or leasing velocity as people had talked about 6 months ago. Now it could occur, but it really hasn't. We haven't seen that just yet.
Yeah, and once again, we saw some smaller clients of ours actually move out of New York City. Do you think they're going to either move back, or you just think they're going to be replaced by different companies and different industries?
I think they're a little bit of both. I mean, as I mentioned, I think they're going to be replaced by different industries or even other larger tenants who are maybe trying to make some of that office space space, make it into a lounge or make it into a gym. But listen, I think this is going to really make a lot of the owners and operators who were sort of sitting idle relative to their building improvements to start, improving their building stock. And I think long term, I think it's going to have a positive aspect in terms of where the office market is moving, integrating and, new technology relative to being more health and safety. So, listen, I think it's hard to predict, but again, with everything, hopefully the next 6 months or so, we'll start to see more leases being done, start getting a clearer picture.
And talking about the subleases, do you think a lot more people, because there's such a huge availability now in the sublease space, do you think more companies are just going to choose to stay put rather than put their, once again, if they're growing or if they need more or less space?
It's hard to say. I think what people are doing right now is just testing
Okay.
what their needs are, testing what the market is. So I think it's hard to predict that, honestly.
Yeah, and we're just going to move into our next polling question. When do you think businesses will start having employees return back to the office? And remember, this is start, not like full time, but like start asking employees to come back. And I think this is going to play a huge role in the future of office, the time period. I think the longer this goes on, the more people are going to say, hey, I can work well out of the office. People are becoming more efficient. Companies are buying more technology. But I think, like, once again, I talked to the partners at Janover, I talked to other firms. They're really eager to get people back into the city and into the office as soon as it's safe to do so. So, and what do you think, Dan, about, like, a lot of these offices put in all these requirements, temperature checks, and only a certain amount of people in the elevator? as you don't need those type of things and as it goes away, do you think that people will be more willing to go to the office because they don't have to get their temperature checked and they don't have to go through all these, hoops and jump through all these hoops to get in?
Yeah, I mean, our expectation is yes. I think once you don't have to do that, you have a vaccine, you can come as you go. There'll be updated amenities for the office space, as you mentioned. We believe people want to be collaborative. I know I do. I think from a focus standpoint, in terms of meeting with clients, and again, that's where the retail comes in, reopening restaurants, meeting for clients for lunch. So it's all interconnected. And obviously, it's going to take a while to get back to where we were, but I think. But by the fall, I think we'll really start to feel some sense of normalcy.
So one of the questions that came in, and I'm just reading through the questions. It was actually a really interesting question. It's regarding office rentals. How does Westchester and Long Island compare to New York City? I think you mentioned that there was like interest, and a lot of people were talking about Westchester and Long Island, but it never really materialized into like huge amounts of companies leasing bigger spaces in the outer boroughs or in Long Island and Westchester. Do you have anything to add like about that, or is it really?
It's not my specialty or my field, but just in terms of the what I've been seeing in the marketplace, I haven't seen a large shift in fundamental long-term leases in those markets yet. It could happen. I have yet to see that.
Yeah, and do we have the answers to the polling questions, Chris? Here, there we go. So this is actually interesting because for residential, they didn't think the vacancies were going to go down to the fourth quarter, but a lot of people think employees are going to start coming back in the second and third quarter of 2021, and that's a huge shift. They only thought 15% of the respondents only thought that residential was going to come back down to the vacancies in the second and third quarter, and that's over double. Think that people are going to start coming back into, um, you know, the offices. So that's do Dan, I don't know about you, but I'm very surprised that there's a mismatch there, that they think that people can come into the offices a lot sooner than move back into the city.
Uh, yeah, it's probably more so for the people that are, that have moved out of the city that are coming back relative to the people that are going to move back in long term. But it's hard to say. I mean, I see the rental coming first. But again, either, both at the same time, you never know.
Well, I thought about it like you. I thought the residential was going to come back first. That would push the office, but maybe it's the opposite. Maybe it is that the office is going to start pushing people back into the city, and people are like, okay, let's start renting again here. So it is that dynamic that all these three, the multifamily, the residential, the retail, like people aren't going to go back to the office if there's no restaurants open, right? So I think they all play together. Um, so I just want to keep it moving. We're already a half hour into this, but I did want to talk about the political landscape. I think this is probably the most significant factor in residential, multifamily, retail, office. Everything's going to play about the politics. And we can't talk about politics without starting in June of 2019 when the Housing Stability and Tenant Protection Act came out. And that just changed the dynamics of residential leasing almost completely. Um, you know, I'll let Dan talk about it, but it did so
Yeah.
many things that changed the fundamentals of residential real estate and multifamily.
Yeah, and what I touched on it earlier, that was a huge fundamental shift on the investment side and landscape of residential multifamily in New York, and we saw, I would say, probably a 6-month freeze on all type of transactions relative to people buying rent stabilized or fair market units, and I mentioned earlier there was, I would say, between 2009 and 2019, there was a large influx of investors in New York City who were new residential multifamily investors who their game plan was to raise money, buy buildings, get out the stabilizer or controlled tenants, renovate, lease it up, and then sell them at huge multiples. And a lot of people made a lot of money, and a lot of buildings were renovated and converted. And what this did, as I mentioned earlier, was essentially end that business model. And not only did it end the business model, but it also impacted the price of these buildings. And that's something we were working through as we got to COVID. And on top of the multifamily world, I think, the biggest thing that we talk to is also the development restrictions and, what is the city allowing. There was some pushback in Industry City, and this really goes back to the whole Amazon situation. and the fact that the political climate here prevented Amazon from building a headquarters in Long Island City, and we're still feeling that. And I think developers and investors, they fundamentally, they love New York and they want to invest here. But they want to see what's going to happen on the political landscape. And I think and we can move forward, Jason, but
Sure.
with the election coming into play, there's going to be a new controller, a new borough president. There's 35 seats up for grabs. I mean, that's a huge number in terms of what's going to happen on real estate and what's going to happen on development and multifamily. And there's still different legislation like good cause conviction, which could even have a greater impact on the value of multifamily. So I think it's very important to, from the real estate side, to have, a pro-business mayor who's looking at this not only from just a micro basis for the tenants, but from a larger scale in terms of the city and building and, getting back to where we were.
Yeah, I mean, anytime I'm talking to we're doing due diligence or we're talking to a client about selling their building, buying a building, what their vacancies are. I mean, once again, you talked about it back in, June of 2019 when they changed. Now I'm seeing a lot of clients, they get rid of a rent stabilized or rent controlled tenant. They're not releasing the space. They're just sitting on it. And, this is what happened kind of in the 70s and 80s when, these were the rules. And we saw the rules kind of relax over the course of 2 decades back then because people just weren't releasing those spaces. Once again, I have a few clients, and I'll just talk about one of them. They have one unit that's getting rented at $600 a month. The person left. It was a rent stabilized tenant. Free market, if they were able to fix that up and get it to free market, it would be $3,500, $4,000 a month. They're choosing to just sit on it. And we've run it out. They're willing to sit on that for 10 years. So I think that it started before the pandemic, and the pandemic now has just made it worse. So I agree with you.
Yeah, and Jason, from the investment sales standpoint, what's really had a huge effect, not only from a pricing restriction, because you can't increase your apartment's revenue, so it's had a huge impact to where that price is compared to where it was, is on the due diligence and just selling a building and having to really do a full lease review and, as you know, sort of a full audit of all the financials and leases going back 20 years. Because you're missing paperwork and documentation, or you were charging overage rent on one unit, that can have a huge impact moving forward from liability and potential lawsuits. So the amount of due diligence and the amount of scrutiny that buyers are looking at relative to buying a building in New York, it's gone through the roof. And bringing in attorneys and accountants such as yourself to really comb it through, and that's why you're really left a lot of buyers, long-term owners who understand this and are in there for the long haul, and hopefully view that the political landscape is going to change and we get back to where we were. So a lot of these investors are saying, hey, rather than deal with all this political tape, why don't we just go invest in Carolina or
Houston?
But listen, I think long-term, again, I think the political landscape shifts. And I think, this is not going to be forever. And we still believe that the investment market in New York is going to be strong. And I think the people that are looking at this now have a long-term view rather than a short-term view on the ground. So that's why, again, we're seeing on the national side, the majority of deals right now in New York City are multifamily.
But I also think, we said it in the beginning with the multifamily and residential. I think that real estate in New York City is going to get back to fundamentals for a few years. The hedge fund buyers and all those people want a 5-year return. We don't know when the political landscape is going to change. We don't know when the rules are going to change. They're looking for stabilized cash flow where they can get, once again, you said it perfectly, Daniel, the annuity that they're getting, and hopefully there's some upside with increased value in the future. But once again, I'm just going to point out, a new mayor coming in, a new controller, a new Manhattan borough president, and then the majority of seats on the city council. I mean, this is a huge year politically, and that's going to shape the next 5, 6, 7 years of New York City real estate.
Yeah, I mean, listen, Jason, from the perspective of the guy you're buying real estate, right? Previously you look at a vacant apartment and you say, oh, this apartment is, $900. We can get $2,700. So what guys are looking at now is saying this apartment's $900. We can get $900. if
You
you
still have to put in money to it.
so,
You still have
but,
to,
but,
you still
but
have to
if you
fix it
want
up.
to take an opportunistic viewpoint, saying we're going to get through COVID, we're going to get through the political landscape, and you buy this at a, on a cash flowing basis at a, at a much higher cap rate than you could have 3 years ago, when
Yeah.
the world shifts, you're going to be sitting in a very good position. And I think that's why the really smart investors are looking to buy right now on the multifamily world.
Yeah, I mean, I agree. I mean, interest rates play a huge role as well, right? So if you
Yeah.
buy at a 5-6 cap and you're getting interest at 3%, you're making, 3 to 5% a year, depending on, where things go. And all of a sudden, that's better than putting your money in the bank, and it's more stable than putting it in the stock market that can go up and
Exactly.
down.
Listen, you have to have the equity, right? It's a lot harder to get a loan right now, but if you have a banking relationship and you sort of, put in a fair amount of equity, and you sort of kick the can down the road in terms of renovation and cost. And as you said, you can collect a little bit of an annuity. Again, your upside can be tremendous.
I agree. I think the upside in New York City is the big thing right now. I'm just going to move on because we're just running out of a little bit of time, and I want to have some time for questions. Let's start with tax planning opportunities. Once again, values are down starting, with multifamily in June of 2019. Now you're seeing some opportunities in office and retail markets, with appraisals being down from 2015 heights, anywhere from 20 to 70%. Obviously, building by building differs greatly. It's a great opportunity to do estate planning. It's also a great opportunity to do estate planning. And once again, I think that this is all my big real estate clients are looking at estate planning right now and gifting, President Biden won the election. The Democrats control both houses of government, and this is the plan. So I'm just telling you what they put out there as their plan. First of all, right now, gift tax at the federal level is 40%, plus you have the state taxes. They want to raise it to 45%, where it's been, historically under Democratic controls. They want to lower the gift tax and lifetime exemption to pre-Obama levels, not even Obama levels, pre-Obama levels, which right now you can get $11 million of gifting free. They want to lower that to 3.5. So that's a huge difference. And then the biggest difference for real estate is really the elimination of the step up in basis. A lot of family owned real estate, generational real estate, there's very, very low basis in it, right? And in the past, if there was inherited property, someone passed away and passed it down, you might have to pay estate taxes, but at least you got to step up in basis. Under their plan, you'd stay at the low basis. So imagine, you have to sell a building to pay the estate taxes. You also don't get a step up in basis, so you have the gain that you have to pay the sales, the income tax on. And we're going to talk about income taxes in a second, but you also have to pay the estate tax. So it can be really detrimental to real estate in particular, especially generational real estate. As part of the administration's tax plan, they want to do away 1031s. And that was, a huge play for, getting out of the New York estate tax. You can do 1031 to a Florida property, gifted at that point. So there was some play there. And I think that a lot of movement in the market was 1031s. I look at a client that owns a $100 million property that they've taken, they've owned it for generations. So they owned it for 40, 50 years. There's very low basis. And all of a sudden, you're looking at a situation where they just mortgaged the property 80% in the past few years. So they have an $80 million loan. They have a $100 million property. Maybe the property is now worth, let's call it 90 million. Let's say it was a small drop of 10%. If they want to sell that property and pay the tax, they have a $90 million gain, but they're only going to get 10 million bucks. So even at the lower capital gains rates, they're actually losing cash by selling it if they can't do a 1031. So getting rid of the 1031 means people might just be staying in place. And then if you look at the capital gains tax, what they want to do, they want to make it ordinary income rates for anyone that makes over $1 million. So that same building sells now, everyone that has a piece of that building is basically going to have more than $1 million of income. And so that's really going to affect, I think, if people are going to want to sell and what's going to happen. They also want to do away with the operating taxes, right? Do away with the 199A, which is the 20% deduction. Anyone that makes over $400,000 a year, which is a lot of the real estate players, they kind of just, they want to just do away with it. And that was a big piece of why, people invested in real estate, for the deductions to keep their income low and their taxes low.
Yeah.
So these are all interesting.
Yeah, and I think, Jason, anytime you have changes in tax plan, there's a pretty big shift on investment sales. With the anticipation of this coming down the road, you might see an uptick of sales. you can see a decline in sales. But obviously, if 1031s go away and on the step up basis, it's going to have a huge impact on the sales market. And I think that's a good segue into sort of the property tax shortfall for the city over several $billions due to the lack of transactions and the transfer tax. And, that's a huge amount for the city, and that's a huge shortfall. And I think, I know Rebney and other, real estate lobbyists are really going to start pushing back against punitive taxes. In this economy, you have all these, these issues, vendors and buildings that are going to be foreclosed and tenants are rent, and then to have to deal with the property taxes on top of that, it's really going to impact landlords moving forward. And I think really the issue that everyone should be involved in, from Rebney and the lobbyists, is really that restructuring the real estate tax in a way where it doesn't unfairly fall. And a lot of it really falls on some of these multifamily owners, because if you have a co-op in Park Avenue, they pay very minimum tax, and you have a middle-class housing in Queens, it's a smaller tax. It's the multifamily owners that have this income in place are really getting affected. So if you want to have small businesses come back to the city, they need to have affordable rents. You need to have retail, and you need to work with the landlord who needs to have to be work on their taxes. So I really think restructuring really could help everything moving forward.
I agree with you. We're going to go out of order. We'll go back to some of the other tax planning and opportunities, but I think it's a good time to talk about real estate taxes. And I think that a lot of the people online, I'm just going to tell you how real estate taxes in New York City work. First of all, they assess it before the year starts. So the 2021 taxes were assessed before the pandemic. So your tax rates are locked. You have to pay them until you can get a chance to file your certiorari, March 1st, and go through that whole process of the certiorari attorney making your case for you in front of the real estate taxes board. And you have to file your RPIEs in June so they can see it and they can reassess. There is a few things to mention. They have this little transfer tax situation. There's like a transitional tax that they came out with because of the pandemic, right? So they want to limit the downside. So if your rents went 50% lower in the pandemic, you're not going to get a 50% deduction in real estate taxes. They kind of want to stabilize it a little bit. Maybe if you have a 50% deduction, you only have a 15% deduction in your real estate taxes. What I want to mention here is it's really tricky because the transition also talks about other years. I'm going to give a quick example. If you had $1 million in rent and it was kind of stabilized, you're expecting $1 million in 19, $1 million in 20, $1 million in 2021. I know that there's usually increases and decreases in vacancies, but let's assume that stabilized, it's $1 million. And all of a sudden you had $1 million in 2019, so they assessed you at a certain portion. And now in 2020, your rents were down 30%, and you're only collecting $700,000. And that was 2020, and now 2021, maybe you'll collect $800,000. But that rent didn't go away, and you're going to collect it in 2022. You're going to collect it in 2023. What could happen if you don't follow the certiorari's correctly, and I really think you have to talk to your certiorari attorney, you have to talk to your accountants, is this year you're going to show 700. It's going to fall. Next year, you're going to show 800. It'll go up a little bit. Maybe it'll be a 3 or 4% increase, and you have that 15% decrease, or maybe a 10% decrease in 2021. You'll have a 3%, 4% increase in 2022. But then all of a sudden, you're going to show your certiorari, and you're going to show your RPIE at $1.2 million. And the next year, you're going to show it at $1.2 million again because you're collecting the past due rents. That can be very, very scary because by the time you hit 2023, 2024, even though your stabilized rents are still $1 million, you might have real estate taxes that are 5% higher than your 2019, 2020 real estate taxes were. On the other side, if you're doing it on full accrual, you're not showing the decrease. You're still showing that $1 million. It's stabilized, but your real estate taxes are never going to go down, and they're slowly going to trickle up. So I think it's a really, really important realization here that hopefully Daniel, you nailed it. New York City has to do something about this. Between real estate taxes and transfer taxes, 50% or approximately of the New York City budget takes place. In 2020, that was 20%. So they're really relying heavily on the spending of New York City for these taxes, and you can't get blood from a stone. So it will have a huge effect on the future. And I really, once again, I think that the people talk to your, city council members, go vote. This is a big thing. And Daniel, once again, what happens if they just keep on, they don't ever lower the real estate taxes or adjust it.
Listen, I think you're going to have a lot of vacant space, and you're going to have a lot of landlords who are dealing with lenders, and you're going to have a snowball effect. So I think they have to, and they have to make this city more friendly for businesses and landlords. And, I think RevNY is going to really make a push on that this year.
Yeah. So I'm just going to go back for a second to some other tax planning information. QOC investments, the 30-month improvements and the investment periods were both extended again. So I think you have till like April of 2021 to do those investments all the way back. So maybe it was 120 days, but you can 180 days, but you can actually get more time. So if you have a big gain, you can still invest. And who knows if the QOZs will go away. So you might want to do it before it goes away. Excess business loss rules were suspended from 2020, right? But not for 2021. So right now, if you're relying heavily on debt or mezz debt and you're paying interest, you might not be able to deduct that interest. So your taxes will still be in effect. And then just remember for 2021 also, the 163J limitations, which is the amount of interest you're allowed to deduct comparable to your adjusted gross taxable income, is changing. And in 2022, you don't get to use depreciation to increase your, depreciation kind of is like taken out of it. So you had a higher ATI, so you can deduct more interest. 2022, that goes away. So now you have a lower adjusted taxable income, and so you can deduct less interest at a time when you're requiring more loans, when you're putting in more money. So it's just, once again, talk to your accountants, talk to your lawyers about real estate taxes, about your certiaries. I think that there could be a lot more certiaries filed this year because just people need to lower their taxes. And then with all this going on, there really was not a great amount of stimulus out there for real estate, whether that was because Donald Trump and his family were real estate people in New York or not. The few things that have helped a little bit is if you have a federally backed mortgage, there was a foreclosure moratorium. What happens when that moratorium goes away? I think they're pairing the moratorium with evictions. So as soon as you're allowed to evict, the moratoriums will come back. So we'll see how that plays out. New York rental assistance program, it really didn't help grade A properties in Manhattan. It really helped, low income housing and things like that more. It helped only a very minority of owners in New York. PPP was available for like management companies and construction companies, and now with the new PPP, it's available for housing cooperatives, but it really didn't help the investors of real estate in the city.
Yeah, I think, Jason, where it helped with the tenants in terms of paying the rent and working with
the retail and office
giving
tenants,
them
for sure,
deferral,
yeah.
and the retail tenants that really needed it, and working with the landlords. I think it was short-term Band-Aid, but again, it's keep those tenants to float them money to help pay their rent and other expenses. But again, it's a short-term for right now.
I mean, look, I saw some of our landlords actually pay Janover to do the PPP loans for their tenants to get the money in so they can get rent. That is a strategy that was used. Two other programs are the EIDL loans and the Main Street Lending Program. I'm not big on either one of those really for real estate. EIDL was kind of a flop for us in real estate from what I've seen. And the Main Street Lending Program, you still had to go through the bank underwriting. So if you had high, if it was still a risky loan, if you still had other debt on it, if you had to do this as a refinancing, and the interest rate wasn't great, right? So there was stuff out there, but it wasn't great. If anyone on the call is interested in any of these programs, reach out to Daniel or myself. We can help you. But I mean, once again, I agree with you, Daniel. It helped some of the tenants, and I think it was a short-term Band-Aid, as you said. It really didn't help long-term or even a lot of our clients short-term problems that they were seeing.
No, and listen, I think the tenants that were working with their landlords to work things out, I think they were able to, the PPP helped, but I think there was long-term structure there with their relationships that were actually more important than the actual PPP.
I agree. So let's go into the last polling question. We're coming towards the end of our webinar. Will New York City raise real estate rates? And this is a huge question. There's a few other polling questions, so we're going to go through a few of them. Once again, I think real estate taxes and what they do with real estate taxes, I think the political environment, those two things will be the most important indicator for the future momentum of real estate and whether or not people want to invest in the short term. I think long term, I think everyone's, and anyone that bets against New York in the long term is foolish. But there's a lot of indicators and a lot of things that can go on. So Chris, if you want to show the responses. So most people think that they're just going to raise New York City rates and they're just going to keep spending. I hope that's not the case. I hope they come up. I mean, they didn't
Me
do a
too.
transition plan, so we'll see
There
what
has to be
happens.
some sort of restructuring. There really does.
I really hope so.
Yeah.
And in the short term, please follow a certiorari. Make sure you talk to the lawyers and accountants because that's going to be a big difference in whether it goes. Don't look at just 1 year. You got to look at the future years too. Next polling question, just quickly, if you're interested in either Daniel or I or someone from the Janover team or someone from the CBR team reaching out to you, if you have additional questions, please. We're not going to share this polling question, but please answer it. And then let's just go quickly to the question and answers. Once again, there is a question and answer format. Please type your questions. Most of the questions that I see already were answered just during the webinar, but please, me and Daniel will be on for another few minutes to answer as many questions as you can. And we're here. If you don't want to ask a question now, you have a question about a specific property you own, please reach out to Daniel or myself directly. With that being said, Daniel, thank you so much for joining us. I hope, in a few months, maybe we'll give another update. I hope things are, once again, looking better in a few months. I do believe, once again, what's CBRE's outlook in the near term? Just generally, not subdivided, but generally, what quarter are you seeing that, you guys think it's a pick up or?
Yeah, listen, Jason, I think we have our reports on the phone, on our website. And, I think our anticipation, as I mentioned, as we get the vaccines, as we start the schools open and restaurants reopen and people start coming back into the city, we'll start seeing leases being signed, and then we'll start seeing retail leases being signed. We'll start to get a sense of where those rents are, where once those translate into actual underwriting, we'll start to see sellers start understanding where the market is. Listen, we're selling now, right? We're selling now, and our anticipate, there are buyers and there are investors long-term in New York. It's just a question of, when does the market from a pricing standpoint start getting closer to pre-COVID level? And I think it's hard to say, but first things first, we need people to be back in the office. We need everything to reopen. We need the vaccines rollouts. And then, our anticipation, and I think CBRE's anticipation, is by the fourth quarter of 2021, we'll start to see a more increase in volume, transaction, and pricing.
So one good question came in, and then we'll end this around 10, like we planned, Daniel. What areas of New York City are holding up the best, specifically in Manhattan?
So we're seeing the dense residential areas, be it where it's the Upper East Side or certain areas downtown that are, for instance, where a lot of restaurants are by NoHo, where you have residential, you have some of the private schools that are still in tow. That's where we're seeing. As I mentioned, down in Williamsburg and Brooklyn, it's not the city, but it's areas where you have foot.
Oh, Daniel, you muted yourself. I'm sorry.
A lot of
yeah, here you go.
And a lot of areas where you have residential density are really holding up the strongest right now. And I think once you see some of the office tenants get back and you'll have the foot traffic around the office, I think those are going to be the last offices to respond in terms of the markets. But again, I think it's the residential areas that have, schools and different other avenues for people to go out and to work right now.
Thank you. And Daniel, thank you so much for joining us today. And, once again, we're going to try to post some information on the Janover website. But as Daniel said, go to CBRE. They have their reports. They're great. I read almost all of them in the last few weeks, and I read them every quarter. So please do that. And thank you, everyone, for joining us. And have a great day.
Thanks, everyone. Thanks for having me, Jason.